Good evening, friends. This is Aurel David here. Welcome to Adventure Terrain Ventures. So, today we're going to talk about a very important topic, that is market timing. In fact, what does it mean? We are going to talk about timing the market. This timing of the market is done for the purpose of short term income creation as well as for long term wealth. So before that, let's look at what are the challenges the investors face or the traders face today. Basically, the investors have an uncertainty. Even if funds are just kept as it is in the bank or in any trading account, it's not going to grow at all. And if funds do not grow, inflation is going to be in effect. Even a 3% inflation would over a period of 25 years can reduce one's purchasing power by half. That's the reason today 46% of investors, they are considering delaying their retirement. Now look at this market. You see this is the chart of the Nifty. In the last couple of months, how has it been performing? Now, this is the way market usually moves. What would be a good strategy here? Would it be a good strategy to buy and just keep holding stocks? Does one need to be really educated in this market to benefit from the various ups and downswings? Or would it be a better strategy to buy at the dips and sell when you have the tops? So buying at the bottom and selling at the top is what we call timing the market. Now some investors feel that, oh, it's really impossible to time the market, so let's just buy and hold. Some people they do something called an SIP, a systemic investment plan, where they monthly keep putting money into the market. And this is what most mutual funds teach the investors today. They say you just cannot time the market. It's not possible to time the market. So the best thing to do is just keep buying over a regular period of time, some fixed amount of investment on a regular basis. And that's what they call as a systemic investment plan, SIP. Very popular today. A lot of people get into SIP simply because they feel that timing the market is not possible. However, to get better returns on your investment, and if one can develop the skill of timing the market, they can do much better than just investing on a regular basis and trying to get an average buy price for your investments. So how does one decide which is a top and which is a bottom? How do we pick these bottoms and tops? Now that's the main topic of market timing. That is, deciding the right time is when is to buy and when is the right time to sell. Now most of us have this habit of watching the news, and the illusion of news is something which not all of us know about. Many of us really do not know that there is a game that all these institutions are playing, and many of us do not know the rules of this game. So how money is made and lost in this market? Mainly there are two groups of participants. All transactions and all trading is done among and between these two groups of people, or rather I won't call them people. One group are the institutions and the banks, And these are ones which are always very, very profitable. And there's another group, they are the retail traders and the investors. And most of the time, these people are struggling to make a profit, or they lose most of the time. So how institutions handle risk? Mainly institutions take more risk in a down market. So when markets are down, that's when they pump in a lot of money and they take a lot of risk. Well, if you look at retail traders and investors, when markets are down, that's when they take the least amount of risk. Okay, in fact, you would see them taking more risk when markets are on the up. So what we need to do to be able to time the market well, we need to be learning to act and behave like these institutions. See, conventional trading that we all read on the internet or read in books, they talk about all these kind of patterns we call as head and shoulder patterns, double tops, double bottoms. Then some people trade based on news. Okay, others would use indicators like Bollinger Bands or stochastics, MACD. All these are technical indicators. Some of us trade using broker tips. A lot of brokers, they give tips. So they tell you to buy and sell. So many of us use this broker tips, and the main intention of brokers to give a tip is so that you buy and sell something, whether they make a profit or not, they make their profit by way of brokerage. Another way is using pivot points. So for many day traders, commonly use pivot points. But I'll tell you, this all conventional way of trading, most of the time ends up in a net loss. The real profitable trading is done using the concepts of demand and supply. Demand and supply is nothing but just economics. We all know when there is more demand, price has to go up. And we all know when supply exceeds demand, price has to come down. And using the same very basic law of economics, you can actually use it for timing the market. So what is this principle of demand and supply? Now, one thing we need to realize, many of us do not know this, that market it moves up and down. Market price, it moves up and down based on demand and supply of institutions. So there is an institutional demand and supply. Why would I say it is because of institutions? That's because no single retail trader, or maybe even a group of retail traders, has enough big account size to cause a market to move up or down. It's only these institutions that have access to large amount of funds, and their size of orders are so large that whenever they buy, they cause the market to move up, and whenever they sell, they cause the market to move down. In other words, if we look at a price chart, you will be able to see their footprints. So whenever they place the buy orders and whenever they place their sell orders, that's going to determine where price is going to turn and where it's going to go from there. So in our course, the Stock Market Model Street, we are going to discuss a strategy which will help us using price charts find out what are these institutions doing. In other words, at what price do they have their buy orders, and at what price do they have their sell orders. And then once we have determined these price levels, we would then buy where the institutions are buying and sell where the institutions are selling. Unlike conventional traders who use indicators which give you buy and sell signals, and these indicators usually lag, no, we would actually be ending up identifying the market turning points. That is, picking the bottoms and picking the tops. So money is always made in the market by buying low and selling high. There's no other way that money can be made. And this is the very basic concept behind our course, the Stock Market Model Street. So here is an example of picking the tops and the bottoms. This is a monthly chart of Tata Motors. So let us look at this particular price action right here. So you can see that market has been on a rise. Tata Motors has been rising for a couple of months here. It gave a pause for a month and then it fell very sharply down. So as per the rules that we adapt in identifying areas of demand and supply, this area here is a qualified supply area. So what we have done here is we have picked a top. Now we don't try to sell here or do anything right here, because only after this fall we know that this is a sharp fall. You'll never know right here that this is a sharp fall or not. And after it has fallen till here, it's too late to take any action right here. But we know that at this point, being an area of supply, a good area of supply, there would be a lot of institutions waiting to sell over here. And this is where the institutions have placed their sell orders. Now, though it took many months for the price to come back to this level, you can just see what happened when price did reach this level. So there was a very sharp fall again. So this is where we can pick this top. So this top has been picked. We sell at this area of supply. So we sell at this area of supply, and after we sell at this area of supply, we look for an area of demand, and that's where price is going to go. So this is where prices have turned, and where the price will go is to the next qualified area of demand. So what you can see here is again a price falling, a period of pause, and then the price rising very sharply again. So this is another qualified area of demand. So if I have taken my short position here, if I have sold Tata Motors right here at this price, I hold my short position all the way right up till this area of demand. So I would be out of my trade somewhere around here. Or if I missed it here, I would be out over here. So my entry price, or the price at which I go short, is roughly around 587.8. That is very close to the historic high of Tata Motors, which is at 612. So at 587, we go short. We hold our short position for a couple of months. You'll have to hold it in futures and keep rolling it over for a couple of months. Now, every month booking some very good profits and getting out at this demand zone, which is at 338. So we make a profit right from 587 to 338. That's roughly about 150 rupees. So this is basically a good example of picking a top and picking the bottom of Tata Motors price chart. Since this is a monthly chart of Tata Motors, this would be an example of how one would build long-term wealth by picking the tops and bottoms in Tata Motors monthly chart. Now can we also use this concept in building short-term income or creating short-term income. So I will then take you to another price chart to show you an example of how we can pick tops and bottoms even for creating short-term income. So I'm looking for the chart of Bharti Airtel. So we got the chart of Bharti Airtel here. So let us now go to a lower time frame. Now I'm going to a 10-minute chart of Bharti Airtel. So let's look at this chart of Bharti Airtel. This is in fact a trade which I took myself this week itself, very early this week. Had identified this trade many weeks back. So as you can see here, this is a qualified supply level. We have price moving up, a period of pause, and a sharp drop down. So in a 10-minute chart, okay, this would be a very short pause, maybe for just 20 minutes. Whereas in the previous chart, we saw a pause of 1 month. Here we are seeing a pause of just 10 minutes. Now both of them work equally well. So the concept of demand and supply can very well be used in the same way for both building long-term wealth and as well as short-term income. So short-term income is created by doing trading, and this is an example of a day trade, an intraday trade. So just we wait for price to come back to this level. And as you can see over here, price did touch this and enter this area of supply and sharply fell from there. So this is a trade which I took. So as you see here, we are selling at an area of supply and buying at an area of demand. If you look at this closely, I usually take this trade only the first time prices enter my area of supply. But this supply zone was actually so powerful that it reacted even here. So even I was out of my trade right here itself. But then for the second time when price entered this area of supply, prices dropped again sharply. Then if that was not sufficient, third time, again, it entered this area of supply right here, okay, and it dropped again. So now we have prices entering this area of supply close to the end of the day for the fourth time. But I really don't expect now for this supply level to hold. Supply would break very sharply. So I usually enter it only the first time, though certain people still enter the trades even the second time or the third time. So now let us look at the chart of the Nifty. We've been analyzing this chart of the Nifty every week now. We have not been able to find any trades in the Nifty very recently. It's only that stocks are giving us very good trading opportunities, but the Nifty has not been. It's quite typical of the Nifty. I don't really like to trade the Nifty at all point of time because there is too much of retail participation in this. I would always like to pick up those stocks which have high institutional participation, because if I can see institutional footprints, I know where they are buying, I know where they are selling, and I can just follow those institutional orders. Whereas in the Nifty, there is too much of retail participation. So it's the Nifty futures that most traders, the retail traders, love to play with. So you don't see much of institutional activity right here. So as you can see, this is here an area of demand. This is a newly, not a newly formed, but it was formed say last week. We have this drop, we have a base, and we have a sharp rally up. So let me just mark this area of demand. So I would look at buying Nifty if it comes into this area of demand. That is somewhere near 11,565. My stop loss would be at 11,530. But as of now, if let's say on Monday when markets open, they straight away fall into this area of demand, I would not want to buy. The reason is because of all these candles here, which are showing some basing action. So this would kill my risk to reward ratio. So if prices sharply fall and open right here, I have an area of supply here. And this area of supply would not allow prices to move higher. So I would only take this a long position into this area of demand only if I can see a very clear risk to reward ratio. So coming to supply, we don't have yet any area of supply. Okay, we have one small area of supply right here in the daily chart, but then price has already reacted from there today. So I would not want to do anything right here. And moreover, since Nifty is making historic highs, I would not like to take short positions because to be able to take short position, I would like to see supply zones formed in the at least in a weekly chart. So let's look at the weekly chart. So in this weekly chart, as you can see, there is no supply zone formed yet. So since there is no supply zone in the weekly chart, I will not think of taking short positions in Nifty at all. So let's look at the monthly chart of the Nifty. So monthly chart of the Nifty looks very bullish, right? So this is an area of demand that we have here. This rally base and this rally is an area of demand. So somewhere here only we can think of buying. So there's a long way for market to fall before we can actually start buying. So till then, friends, trade only the specific stocks. Don't trade the Nifty because there's not much of opportunities in the Nifty to trade as of now. I am right now only trading specific stocks and I'm getting very good results by following demand and supply. So that's all we have time for today. It was really nice talking to all of you. Do visit our website, that is adventuretarianventures.co.in, and subscribe to our course. And there's a lot of other educational videos out there. Do check it out. Thank you.